You spot it, the classic cup and handle. The price hits resistance, you execute a buy order, and instantly, the floor falls out. Your capital is suddenly trapped in a violent reversal. In the highly leveraged world of Forex and CFD trading, relying strictly on basic shape recognition is a reliable way to lose money. What you likely experienced is a false breakout. That momentary spike above resistance is designed to lure in eager retail buyers right before institutional momentum shifts in the opposite direction. To survive these markets, you have to stop staring at the surface-level geometry and start analyzing the invisible data engine actually driving the setup. Professional traders use a systematic filtering method. Think of it as a validation blueprint to eliminate weak setups and verify true breakouts. Shifting your approach from passive pattern spotting to aggressive systemic validation turns a devastating market trap into a highly calculated, profitable opportunity. The cup must form a graceful U shape, showing a stable transfer of power to buyers. A sharp V shape is immediately rejected. Then the handle forms. If this retracement drops below 50% of the cup's depth, the setup is entirely invalidated. But a perfect shape means nothing without the underlying data layer. Trading volume is the secret engine that confirms if the visual pattern is authentic. Volume bars noticeably diminish as the cup rounds out, proving selling pressure is exhausted. As the handle forms, volume goes completely dead. The true signal happens on the breakout, accompanied by a massive spike in volume that fuels the upward momentum. A flawless geometric shape without that volume surge is a guaranteed trap. Volume acts as the ultimate polygraph test for the market's true intentions. Identifying a valid volume-backed pattern only gets you halfway there. You still need a mathematically precise entry point to execute the trade safely. With the aggressive entry, execute a buy order the moment a candlestick closes above resistance on high volume. It risks a false breakout. The conservative entry waits. Let the price retest that broken line as new support, and enter when it bounces higher. But Forex adds its own variables. You have to account for the spread, the difference between the bid and ask price. During a sudden, volatile breakout, the spread can widen and artificially inflate your actual entry price by several pips. Because of the high leverage available in FX, entering at the wrong microsecond during a widening spread can instantly magnify your exposure. Choosing your entry technique isn't a matter of style. It requires matching your personal risk tolerance to the immediate liquidity and spread dynamics of the market to aggressively protect your capital. Which brings us to the final phase, exit parameters. Every trade requires strictly defined risk and reward levels, calculated before you ever place the order. Calculate a profit target by measuring the pip distance from the cup's bottom to the rim, projecting it upwards from the breakout. Place your stop loss just below the handle. Alternatively, tighten it below the breakout candle, though this risks early stop-outs. Whatever your placement, it must fit the 1-to-2 risk-reward ratio. The potential profit you are aiming for must mathematically double the potential loss you are risking. This diagram illustrates the cardinal rule. If the distance to your calculated profit target isn't at least twice the distance to your stop loss, you simply walk away from the setup. Rigorous risk management provides the mathematical engine that separates long-term professionals from impulsive gamblers. Executing these high-probability breakouts requires institutional-grade technology. You need ultra-fast execution, and 0.0 pip spreads adds to the volume surge accurately without slipping on price. Join thousands of traders on NX1 and open an account today to trade with total clarity.